Two very different but very important companies reported earnings over the last 24 hours. Netflix, the popular streaming service, and Intuitive Surgical, very different business that makes robotic surgical systems that are used throughout the world. And both stocks are down big today on that news. And while I don't own either one of the stocks, there's one that is becoming more and more interesting to me over time. We'll get to which one that is in a minute. My name is Brian Stoffel. At the time of this recording, as I said, I don't own shares of either one of these stocks, and I want to give a shout out to Fiscal AI for sponsoring today's video. Excuse me. So let's go through each one of these one at a time. We'll start with Netflix, about a $300 billion company. Let's do the headline numbers first. So revenue was up 13% year over year. Importantly, that missed analyst estimates and slightly missed management's own guidance. Earnings per share of 80 cents was just ahead of analyst estimates and management's guidance. But those misses are going to kind of play a role in understanding what's going on here. If we look at margins, there was not a great story here as well. Gross margins were flat. Remember, most of this is amortization and depreciation of all the content that they've created in the past. But operating margins did take a step down, albeit slight. Same thing with net margins. Free cash flow came down. Some of that had to do with the timing of a tax payment while net income rose. And believe it or not, while this balance sheet is upside down, which means there's more long-term debt than cash on hand, it's actually the closest to being even that it's been in quite some time. Let's go down the income statement to figure out what's going on. So as I said, revenue was up 13.4%. The cost of that revenue was up just about the same amount, which means that's why gross margins were so close to each other. Here's the problem, though. Operating expenses grew faster than revenue. So again, when you're spending more on sales and marketing, on technology and development, on G&A, and your revenue isn't able to keep pace with that creates a problem. And that's why operating income was up less than it was the same time last year. Now, there were some extenuating circumstances, the World Cup, for instance, drawing more fans away. And believe it or not, having access to those live events, it can be a big driver of new signups. And it's not the amount of time that you watch that really technically grows that top line. It's signing up for the service. And so they talked about how in Japan, for instance, the World Baseball Classic was a huge sign-up bonanza for that region. There were fewer of those because the company didn't have World Cup games. Net income was up 9%. Again, this is slower than revenue, and investors don't like seeing that. One bright spot is the company did buy back shares, and the number of shares outstanding was actually down 2% year over year. Now, for a bigger picture of what's going on, we're going to head over to Fiscal AI. This is a tool that I use literally every day, and if you'd like to use this tool as well and have 15% off an annual subscription, second link in the show notes below will help you to do that. Now, when we go to Fiscal, there is somewhat of a problem, and it's not because of Fiscal. The problem is that I've gone to segments and KPIs, and you have to see all these different things that Netflix doesn't give us anymore. They don't give us membership editions. They don't give us the average paying memberships. They don't give us even the revenue per membership. And that is problematic. And the company announced today that they're also going to lower the number of releases that they have about engagement on the platform as well. They did say the number of hours viewed was up 2% from the same time last year, and that was an acceleration from previous quarters. But still, the less data they give you, I don't love that. And usually investors rightfully assume that when data is being withheld that used to be published, it's probably because it's not going to reflect well on the company. So there's no way we can know if that's the case. But here is what the company does give us. The amount of revenue coming from different regions. This is the United States and Canada. And you can see the two that do the heavy lifting are the US and Canada, and EMEA, which is Europe, the Middle East, and Africa. Those do the big lifting. Then we have right down here Latin America, and finally the Asia Pacific region. If we look at the US and Canada revenue growth, it has slowed from 18% during the holiday quarter down to 10% this quarter. If we look, and there is the law of large numbers, but we're going to see the same dynamics here, where EMEA growth went from 17% down to 14%. Again, had fewer headline live events occurring that get people to sign up, and that can really slow down on member sign up. Now, if we do look in Latin America, that did continue growing. It is off a smaller base, but that's good news. And finally, in the Asia Pacific region, we saw the same trends where that revenue growth rate was slowing. That's not the end of the world. You do have kind of the law of large numbers, although this is a smaller portion that are at play here. So that's what would happen during the quarter. One of the big problems for the stock moving forward was guidance. So Wall Street was expecting roughly $13 billion in revenue for the third quarter, which would be about 13% growth. Management guided below that for 11.7% growth. That kind of sets alarm bells off. When margins are shrinking and revenue projections are below expectations, that can be problematic, especially when we talk about valuation, which we'll get to in just 1 second. What should investors watch moving forward? I believe gross and operating margins are key. You want to see those stabilizing, especially those operating margins. The revenue guidance will be important because it gives us some visibility into what's happening. And any commentary on ad monetization, because remember, especially in developing economies, that ad tier is a growth driver. Overall, I think the moat is stable. I don't think there's any alarming signs of the moat being encroached on. However, the thesis for this is that you want that moat to be widening if possible. So to me, this is in a wait and see category. Valuation is the other part of this. Before we get to valuation, I want to let you know that if you enjoy breakdowns like this, Stock Investing Mentor would be a great program for you. This is a program that my program has 1 hour of live weekly sessions every Thursday at noon Eastern. You get full access to my portfolio. Every time I make a move, I let you know about it with a full explanation and 24/7 access to a private online investing community. And not only that, by becoming a member of Stock Investing Mentor, you get the newest version of Stock Simplifier absolutely free. If you are interested in Stock Investing Mentor, for 10% off, top link in the show note below will bring you there. Now, I want to show you what you'll get with this. Now, this is not fully released yet, but Stock Simplifier, which is included for free, a $400 value for free. This is our newest iteration, which is set to go live hopefully before the end of the month. So by August, you'll get this. And here's why I want to point this out. We have a new reverse DCF calculator that is incredibly powerful, incredibly powerful. And here's why. We talk about this reverse DCF all the time, and now this is a layout that is much more intuitive. So let's talk about this. Let's think about what we have with Netflix. Let's give the company a 2.5% terminal growth rate, a 10% discount rate. That means that the company will be market matching. What is the revenue growth implied in this? Now look it. We can even optimize free cash flow margins right here. Now I'm gonna do Netflix a solid, and I'm gonna pull their optimized free cash flow margins up to 25%. They're not quite there right now, but if we put them at 25%. And I'm also going to look and see, what do analysts expect this company to do moving forward? So what I'm going to do is I'm going to close all these, and what I'm going to do is I'm going to go to the income statement. I'm going to look at their revenue growth, but then I'm going to look and see, well, okay, what kind of revenue growth is expected over the next 3 years? And the answer to that is, if we see right here about 14, 12, 10, I would say an average of about 12% growth per year. Here's why that matters. If we head back to Stock Simplifier, we're going to say that over the next 3 years, we're expecting roughly 12% growth. Now, here is what this spits out, and this is a thing of beauty. This is saying that if Netflix has a 25% free cash flow margin, and if Netflix grows about 12% over the next 3 years, today's stock price assumes that Netflix can grow about 9% per year for years 4 through 10. What do we think about that? Could it grow at that throughout years 4 through 10? Well, this lets you see where revenue growth has been in the past, and this is where the company thinks it is going. So if you think Netflix can have 25% free cash flow margins and grow their revenue by about 9% per year after 2028, well, then it's probably a pretty good investment today. I'm not totally sold on that. Not totally sold on that. which is why if I were going to pick one of these that I would own, the pick that I would have would actually be Intuitive Surgical, a company that's also down roughly double digits today. Let's look at Intuitive Surgical's results, roughly $130 billion company. On the top line, revenue grew 19%. This beat analyst estimates. And while management does not guide for revenue growth, they have full year procedure growth band from 13.5% to 15.5% procedure growth. It came in at 16%. That's just one quarter, but it came in at 16%. If we look at the bottom line, earnings per share of $2.80, that was way ahead of analyst estimates, and it also grew faster than revenue did. Okay, so then let's look at what we see when we look at the company's margins. What we see is, across the board, this is pretty good. Gross margins expanded. Operating margins expanded. Net margins expanded. Now, free cash flow, which I have down here, that's actually for the first half. The company did not have a quarterly free cash flow that they submitted yet. But for the first half, free cash flow has expanded over 70%. Net income up, balance sheet, almost $9 billion net position. Let's look at the income statement to see what's going on here. So total revenue up 18.5%. The cost of that revenue only up 13%. That's great. Service revenue is a much smaller part of this, so I like to focus on the instrument and accessories and systems, and the systems are those Da Vinci 5 and Ion robots that are placed in hospitals. And what we see there is the gross margins there expanded from 66.5% to almost 68%. That's great news as well. Gross profit up 21%. This is fantastic. Meanwhile, operating expenses only up 13%. And if you look at it, they're pouring about $400 million per quarter into research and development to lengthen their lead over anyone that tries to broach what they've got. That's why income from operations was up 31%. Net income a little bit less, but to me that's less meaningful. And they've done meaningful buybacks, so the number of shares outstanding was down 1.9%. Again, let's head on over to Fiscal AI to see what we can learn about what happened during the quarter. So a couple of things. I talked about how it's really important to understand the business model here. The sale of the systems, the robotic surgical systems, is actually much less important. It is a Trojan horse, if you will, a razor and blades model. It is the instruments and accessories, which are the things that need to be bought for every new procedure. Those are the high margin profit drivers for the company. And as you can see, the instruments and the accessories are the biggest part of this revenue pie, which is really good news. What we see here is that instruments and accessories can be somewhat lumpy, but overall up 18%. It does have some quarters of being higher, but this is not an alarming trend, I would say, by any stretch. If we look at systems revenue, this has been pretty stable. Now, part of that is because the company knows that because the system is quote unquote the Trojan horse, they're willing to make leasing agreements to get these systems in hospitals, which really, it might pull down the absolute amount of revenue that the company collects, but it's still a great long-term business plan. It does mean that the revenue growth is not quite as lumpy as it would be otherwise. So 19% growth was actually pretty good. The services revenue we're less concerned about, but it is worth pointing out that was up about 20%. Now, there are a couple more things, which is great, that we can see here on Fiscal that I just want to point out is the biggest moat around this company is the company's switching costs. Once a hospital pays for this machine, once surgeons are trained on it, they're not going to leave. So the unit placements that occur, that's a big deal. There were 468 total unit placements during the quarter. That was up about 19% from the same time last year. And it just adds and stacks to that installed base overall. Now, if there is one metric that is the most important for investors in Intuitive Surgical over the long term, it is the number of procedures that were performed, which again came in at 16%. Now I want to show you something. What I've created here is just a guide, and what this shows you is where management says full year procedure growth is expected to be as we move through time. So for instance, at the beginning of 2022, they said it'll be between 11 and 15%. And what I've done is plot the midpoint of that and how it changes. This is why it's important. Throughout 2022, management was consistently bumping up the midpoint for how much procedures would grow. Same thing in 2023. Started at 14% and ended all the way above 20%. Look at 2024 from 14.5, 15.5, 16 and a quarter, 16 and a half. Look at 2025, 14.5, 16, 16 and a quarter, 17 and a quarter. Here's the thing. If we look at where we were at the beginning of the year, 14 was what was expected. It bumped up to 14.5, but now management did not bump it up. The first time it's done that since the pandemic. And look, the company regularly comes in well above these ranges. You can see it in the red right here. But management said that they believe that it will trend towards the midpoint. So the revenue guidance stayed the same, and they said it'll trend towards the midpoint. Here's why that's a problem. There was 17, 16, 15% growth so far is what we've got. And the fact of the matter is that if it trends towards 14.5%, the back half might really draw down. Now, there was some commentary about that, and it's important to talk about that commentary. Management said some of this was the change in subsidies to the Affordable Care Act was causing patients to delay some of their procedures. They said some of that was due to capital challenges in Japan, which means some hospitals not being able to pay for this or get reimbursed for the procedures there. And it said some of it, the big thing is what's going on in China. China is an enormous growth market for the company. It accounts for less than 10% of all revenue right now, but it is an enormous opportunity for Intuitive Surgical. The problem is that China is favoring some homegrown alternatives. Now, I don't think that that's going to be a threat for Intuitive Surgical's business that's already established. Once those machines are in, again, Trojan horse here, they're usually there to stay. But the fact of the matter is that if China is able to come up with a reliable alternative that could cap the total addressable market that Intuitive Surgical could go after, and it could put pricing pressure on its ability to get those high margin instruments and accessories revenue. So that's the big thing to look at moving forward. That's why I'm going to keep a very close eye on procedure growth, guidance for procedure growth. Outside the U.S. procedures is really, really important, and those margins. I still believe that the moat is stable or widening around this company and that the thesis is on track. I do think that a lot of investors are worried about what's going on in China and the effect of some of those ACA subsidies. Here's the thing with the ACA subsidies and the effect that tariffs are having on margins, I don't necessarily think of those as structural that will last forever. I think that they could resolve themselves, so I'm less worried about that. What's going on in China is something that I'm going to have to keep a closer eye on, and we always have to keep our eye on are we hitting saturation? I don't think we're there yet. I don't think we are, but that is something to keep an eye on. And for the first time in a long time, Intuitive Surgical actually appears to be a relatively fair value, which is why this would be the stock that I would consider purchasing. Here's what I mean. Going back to the Stock Simplifier tool that you get part and parcel with becoming a subscriber in Stock Investing Mentor. All right. I believe that Intuitive Surgical does have pricing power. So I'm going to give the company a 3% terminal growth rate. I'm also going to give them that because I've been covering this company and I've owned it since all the way back in 2013. Don't own shares anymore. But I know that if you take the pandemic out, they have averaged 15% plus revenue growth rates for well over a decade. 10% discount rate. When we talk about free cash flow, the company is aggressively reinvesting in things. So I believe that free cash flow could be as high as 33%. I'll give them 32% once they're fully optimized. Now, so what kind of growth is needed to justify this stock price? And the answer is about 15% growth. Now, the company is also repurchasing a bunch of shares. So I would be willing to knock that down to even like 14% growth moving forward. So what do analysts expect for revenue growth moving forward? And the answer is, if we pull that up right here on the income statement, is that over the next couple of years, analysts are expecting revenue to grow by 16%, followed by 13 and 13. Now, if we look at the estimates, you will see that analyst estimates are consistently revised upwards. Personally, I believe 14 to 15% is reasonable. So what we're looking at today, to me, for the first time in a long time, is a stock price that is actually reasonable. When you factor in the stock buybacks that could happen, I think we have a reasonable stock price. So this is something that I will be considering moving forward. If you want to find out if I actually do end up buying shares again, Stock Investing Mentor as just one part of that program. Let me know what you thought of these two companies, and of them, which one you would buy today in the comment section below. Until next time, Brian.